Hey everyone, my name is Gary Lipsky from Break of Day Capital. We also have Andy Wong, our investor relations manager. Today we'll be going through our newest opportunity, Icon on Broadway. It's a deal we're very, very excited about because we're buying it at a price that is well below replacement value, de-risking the asset. And there's four quadrants that I'm very excited about that it checks all the boxes. We got cash flow, appreciation, depreciation, and capital preservation. And those are the four things you really want in any investment. So let's jump in. We have our general disclaimer talking about all the things that could go wrong when you invest in a deal. So read it over when you have time to check out the deck. Protects me, protects you. A further disclaimer too that our projections that we make today really hard to nail the projections, 3, 4, 5 years down the road. So a little bit about Break of Day Capital. It's a company I founded at the beginning of 2017. We've raised over $100 million to date. We've distributed over $40 million to investors. And as a team, we've invested almost $10 million in our deals. So we're very, very aligned with our investors. I've written two best-selling books, Best in Class and Invest Smart. I have a podcast that's been running for over 6 years. And we were also nominated by AAOA, which has over 140,000 members, as one of the best syndication companies a few years ago. We've acquired over 1,800 units over the time of Break of Day's lifespan, which amounts to over $320 million in real estate transactions. And our focus, so we're very hyper focused on the Southwest and on asset management. And over the course of our first 12 deals, we've averaged a 40% bump in net operating income in year one across our portfolio, which is a stat that I'm very, very proud of. So why we're excited about 2026 to be investing. So in 2022, you had low cap rates, and that's when you figure out the cost or the value of a multifamily deal, it's based on the net operating income and the cap rates. And in 2022, those cap rates, depending upon which market you invested in, but for Tucson, let's say they were 4% or sub four. Now in 2026, we're getting this deal at almost a 6.25 cap. So a huge difference. That means what we pay for is a lot less per unit. In 2022, you had also very low interest rates and high leverage available, and lots of investors chasing deals. And right now, we have very reasonable interest rates on this deal. We're looking at about a 5.8%, so very reasonable. Reasonable leverage on the deal as well. You're not getting the 90%, and I would stay away from that. And we're getting 75% on this deal. And there's not as many investors chasing deals. So that's why we're able to get this deal just under 110 a door, which is a fantastic, fantastic price. So, like I said before, below replacement value. So, if you had to build this property new, you're probably looking at closer to over twice as much as what we're currently paying for. And then again, that reduces risk tremendously. There's also uncertainty in the market from those listening to the noise. Obviously, you've got geopolitical things going on. You got tariffs, this, that, and the other. And so negative news grabs the headlines. But as Warren Buffett once said, and you've probably heard it repeated over and over again, be fearful when others are greedy and greedy when others are fearful. And that's why we feel now is a great time to buy. And we're very excited about this opportunity. Also, supply pressure has peaked. So you had a lot of units being delivered last year, the year before, and that has dropped off pretty much a cliff because people were building when interest rates were very, very low. Costs were lower, and as costs rose and interest rates rose, that created downward pressure on new supply. And so that's where we're at now. And so you'll start seeing interest rates rise, and we're kind of at this bottom of the market, which is a great time to buy. And I'm sure you've heard home ownership affordability is certainly stretched, which means there's a lot more renters. We've become a renter nation. So why do real assets matter in today's environment? So public markets remain volatile and sentiment driven. Um, you might have a huge bump sometimes and a huge drop in other times in the markets, and that could cause a lot of stress, particularly for those watching the headlines. Gold and digital assets don't produce income. They're a good hedge against inflation, but they don't generate cash flow. They don't have tax benefits, and you can't force appreciation. What I mean by that is when we take over a property, when we improve the NOI 40%, we could do it a number of different ways by saving on expenses, by creating income lines, increasing rents, increasing renewals. You can't do that with gold or digital assets. And housing is a necessity. Everyone needs a roof over their head. So demand will persist across all cycles, particularly in workforce housing, and that's what this property is. Real estate is valued on income, not narrative. Um, just because someone tweets out something or there's a headline, it doesn't really affect the value of the property. It's affected by operations, and operations drive outcomes. So position capital is only step one. Execution is step two. And so I go back to that 40% bump in NOI in the first 12 months. Execution is something we do very well, and we take very, very seriously. And so how do you do that? So underwriting assumes imperfection, not perfection. This is a business, right? Just like, an accounting firm, a Taco Bell, whatever it is, and things don't go perfectly. So we underwrite for that. I also mentioned buying at a basis that provides a margin of safety. And one thing we do very, very well is manage expenses with discipline, not assumptions. And we've been doing that time and time again for many, many years. And that just comes with experience. And structuring incentives so alignment is built in. So what I mean by that is, like I said, our team has invested almost 10 million in the over 100 million that we raised, and also our acquisitions person is also our um, asset manager. So they're seeing it from cradle to grave. It's not one person handing it off to another person. Otherwise, you might have misincentives where someone is just trying to do deals so they can get their bonuses and they can get paid well, where the asset manager has to perform on a deal that was handed to them. But it's the same person. All right. So aligned interest, like I said, I have invested. I'm one of the biggest investors in all of our deals. Our team also invests very highly in our deals. And we manage every decision with the same discipline and diligence we expect from our own capital. So we focus on a few markets so we can be experts in those markets. So we go a mile deep, not a mile wide. And over time, we built tremendous relationships with brokers, and that's why that we got this market. It was an off-market deal, um, and we've known these brokers for many, many years. We're not chasing deals all over the country. Arizona, particularly Tucson, is a market we can get to on an hourly basis. We visit there on a very consistent basis. If this was a market, let's say South Florida, becomes a really hard obstacle for us to visit on a consistent basis. And so that's one of the reasons why we love Arizona. Also because it's a landlord friendly, above average population growth, and job diversity. And we'll get into that a little later. So this is our current portfolio. We have 9 properties under management. We've sold 4 already, above our projections. So currently we manage a little over 1,400 units in Arizona. And this is our latest opportunity. It's called River Oaks, but we're going to change the name to Icon on Broadway, and it's located in Tucson. And as you can see, it's a very nice property. So here are the investment highlights. So we're buying it for just under 110 a door. Loan to value 75%, 5.8% fixed loan with 5 years IO. Class B. Our projected returns on you can see on this third line, 16% IRR and 2x multiple for Class B. And for Class C, for those invest 500,000 or more, it's 18% IRR, and IRR takes in the time value of money versus annual average return, AAR. You should expect 90% plus bonus appreciation in year one and more in subsequent years. Um, Check with your tax advisor to see if you could take advantage of it in year one. Sometimes people carry it forward to when we sell the deal, which is it's still a great benefit. And we have conservative underwriting, like I said before, 0% rent growth in year one, and 6% cash flow in day one too, which is excellent. So key risks, obviously, there's risk with every investment, and our focus is on identifying them, underwriting, and actively managing the risks that matter the most. So we identified four risks. One is market and rent risk, potentially slower rent growth or short-term pricing pressure, and we've been under that, and a lot of operators throughout the country, and we're kind of been moving out of that over the last few months. But how we mitigate that is conservative underwriting, which assumes 0% rent growth in year one, where CoStar and Yardi and RealPage, three of the major platforms, project rent growth about 3% on average in year one of operation. So we have it at 0% rent growth. Expense risk, insurance, payroll, utilities can be volatile at times. That's one of the reasons why we like Arizona, because you don't have the crazy insurance costs like a Texas or a Florida has. And real estate taxes are a max 5% each year, unlike some other states as well. But we also mitigate that by having our elevated costs, not historical lows, with conservative year-over-year increases. As far as interest rate and exit risk, obviously, a lot of people have been affected by higher and longer interest rate environment. But what we are putting on this property is fixed rate debt at a really good rate, which mitigates near-term refinancing risk. And lastly, execution risk in managing a 300-unit workforce housing asset. We've managed big properties like this before, but great asset management paired with a good third-party property management firm really helps mitigate risk. And we have the knowledge base, not just for this will be our ninth property in Tucson, but of over 60 properties in that area. Over 60 properties in Arizona, but there is some focus in Tucson as well. So our business plan, and before we purchase a property, we really go over the business plan, make sure it aligns with the property management company. And like I said before, we'll change the name from River Oaks to Icon on Broadway. Icon is a moniker we use for almost all of our properties. We'll add a package locker so residents can get their packages 24/7, 365 versus having to wait from a 9 to 5 and a Monday through Saturday when our office is open. It gives them it's a nice amenity. We'll also add a pergola and a barbecue area near the pool area. Again, improving daily usability and retention. The property also needs a refresh, so some landscaping. The parking lot needs some updating, painting the property. This improves curb appeal and is a great first impression for potential residents. We'll deal with some deferred maintenance and then cost discipline as well. So reducing some operating expenses while maintaining service quality. We're not going to reduce expenses at the cost of providing bad service. This is something that we've been very experienced in, cutting expenses, but actually improving operations. So these are some pictures of a renovated unit. So 85% are basically renovated to the level that we do at our other properties. So there's about 15% that we could upgrade down the road, but right now this is a really good to have that many units renovated saves us a lot of money. So here the unit mix. There's 4 unit type: studio, 1 bed, 1 bath, 2 bed, 1 bath, and 2 bed, 2 bath. Now there's also some varying square footage as well. And you can see the in-place rents and the market rent. So there is room to grow the rents. And here are our rent comparables. So you'll see that we are below market. So there is, like I said, there is room to grow. Sales comps. So not a lot of deals have sold in the last few years. Deal flow is on the lower end, but I love the price per unit that we're paying and the price per square feet um, that we're paying as well at 155 per square foot. So some Tucson MSA stats. If you don't know Tucson, a lot of people fall asleep on it. It's an hour and 40 minutes from Phoenix. It's got a little over 1 million people, and it's MSA, so the city in the outskirts. What I love about that is it has a pretty good workforce. When you start getting into really small tertiary markets, maybe 250, 500 population, you might struggle with your workforce. So the bigger the MSA at 1 million plus gives us quality workforce that we need, and the unemployment rate is pretty low. Meaning home value is almost 350,000. All right. At this point, I'm going to pass it off to Andy, who's going to talk about some of the investment classes and what it means to be an investor with us. Take it away,
Great.
Andy.
Thanks, Gary. So we've covered the market, the asset, and why we like the basis and business plan. So what I like to focus now is how investors can participate and how returns are structured. So I'll walk you through the investment classes, the projected return example, the waterfall structure, and the next steps. So on this current page, investment classes, you'll see that the slide outlines 3 ways investors can participate. Class A is a preferred return. It offers a 10% annual preferred return with monthly distributions. There's no bonus depreciation in this class, and there's no profit participation by the GP. It's designed for investors prioritizing steady income and simpler economics. Class B is common equity, and this is our most common structure. It includes a 7% preferred return, quarterly distributions, and a projected 90% plus bonus depreciation in year 1, with a targeted 16% IR and a 2x equity multiple. Then we have Class C for larger allocations starting at 500,000. It includes an 8% preferred return and a simpler 80-20 profit split with the 18% target IR. So across all the classes, investors receive their full return of capital before any profit splits occur. So that really applies to classes B and C. So so just keep in mind that we don't participate in the profit splits until investors get their full return of capital back, what we call a European waterfall. One important clarification is that preferred return does not mean guaranteed cash flows. It means investors are paid when cash is available and any unpaid preferred return accrues. But as Gary mentioned, we expect to be paying about a 6% cash on in year 1 immediately. On the next slide, we show
And
projected.
to
I'm sorry, go ahead.
clarify, there should be the full 10% for Class A because they get first dibs over Class B and C.
That's right. That's right. So Class A, the 10% starts accruing and starts paying out monthly right away. And then the next slide on page 22 shows a projected returns example. So this slide shows an example of 100% investment in Class B. So in year one, projected distributions are started approximately 6% from operations. So as a business plan is executed and income improves, distributions can increase over time, but we like where this deal is currently at because we're able to pay a 6% distribution right away. So then this also shows that at exit, investors receive their remaining capital plus sale proceeds. So in this example, 100,000 investment returns approximately 200,000 over a 5-year hold, representing a 2x equity multiple and a 16% target IR. So keep in mind, these are just projections and not guarantees, and they reflect our underwriting assumptions, including 0% rent growth, as Gary mentioned in year one. So we're trying to be a little bit more conservative, taking into account the current environment. The next slide talks about the sensitivity analysis. So this shows how returns can change based on two main variables that we can't fully control. One is the exit cap rate, and then the other one is economic vacancy at exit. So on the top, across the top, you'll see that we vary economic vacancy from 85 to 95%. And then on the left axis, you see we vary the exit cap rate from anywhere from 5.5 to 6.5%. So in the middle gold section, you see that that's our base case, so 16% IR with a 2x multiple. But most importantly, even if you stress the exit cap rates to expand to 6.5%, so at the bottom on the left axis at the bottom, and then you assume that vacancy softens to 85%, so the bottom left-hand box, you'll see that the underwriting still shows that we expect double-digit returns on this deal. So we've underwritten it very conservatively. So and then conversely, at stronger occupancy and tighter cap rates, you can see how returns can move meaningfully higher above the targeted return as well. So this slide isn't to predict the future; it's just to show the range of outcomes under different market conditions. Which is why we like to show it to investors. So the next slide details what we call the waterfall structure. So this is one of the most important slides because it explains alignment. So as I mentioned before, we use a European waterfall, which means that investors get paid first at the deal level before the GP or break of day capital participates. So as you can see in the graphic, first investors receive their 7% preferred return, and then investors receive 100% of their capital back. And it's only after that point that we begin to split profits. So up to 15% IRR, so anywhere from the 7% preferred return to a 15% IRR, investors get a 70% of the profits where we take 30%. And then if the deal does better than projected over 15% IRR, then the split becomes a 50-50. So the conversely, if the deal underperforms, we don't participate in the promote or in this waterfall. That's why we think this alignment's intentional. That if the deal doesn't do as we expected, then break of day capital, we don't participate in any of the profits as well. The next slide is just a similar illustration, but for Class C. So as you mentioned, for the minimum $500,000 checks, similar structure. This just shows that it's an 8% preferred return. And then investors get their 8% preferred return and their capital back first. And then after that, everything's at a cleaner profit split of 80-20 to the investor. So it's fewer tiers, which some larger investors prefer the simplicity, and because of the larger check sizes, their economics are slightly more favorable than Class B. But the principle remains the same. Investors get paid before we do. So the next slide talks about the effects of bonus depreciation. So what happens when more capital stays invested? So in year one, $100,000 Class B investment is projected to generate approximately 80,000 in bonus depreciation. So I know we said this deal we're expecting over 90%. In this illustration, we're just trying to be a little bit more conservative and assuming at 80%. So assuming 80% bonus depreciation loss on a $100,000 investment, that can translate to roughly 28,000 in deferred taxes, depending on individual circumstances. And so the way to think about it is the deferred taxes stay invested as opposed to getting paid to the government in the form of tax. So you're able to continue to earn cash flow and participate in appreciation while your money's still working for you, and you're able to defer and sometimes for some people eliminate the tax obligation. So in this illustration, the deal itself hasn't changed. It's just what changes is how long your capital works. So you can see why at a higher effective equity multiple in IR, when we move it to this tax efficient view, that bottom right hand box. And so the next slide further capture this idea. So this talks about it shows that over time how much the bonus depreciation tax benefits can help investors. So first, it's a you know we're it shows that without bonus depreciation, you can earn $950,000, but over time, as time passes, this effect sort of increases. So the spread you can see with bonus depreciation over the long term, that 950,000, it actually can be worth 1.6 million when you take into account all the various benefits of writing off or deferring taxes and taking that bonus depreciation loss. So we think this is a very powerful tool for investors that really care about the ability to take the loss that we generate from our cost segregation studies. And so the final page just discusses next steps. So if this aligns, I'm sorry, I skipped the investment highlights. So this slide summarizes why we like this deal. So first, it's a well-located Class B workforce housing asset with strong in-place demand. It's not a lease-up story, so it's already stabilized. We're acquiring it off market at a basis more than 50% below replacement cost, which gives us meaningful downside protection. As we mentioned before, it's targeting a 16% IR with a 2x equity multiple. We expect approximately 90% bonus depreciation in year one, subject to individual tax situations. And just as importantly, as Gary mentioned, in terms of the market update, our underwriting for this is conservative, and so we're not relying on aggressive rent growth. So we're assuming 0% rent growth in year one. And so investors can receive approximately 6% cash flow from day one. And so the next slide talks about next steps. So if this aligns with your portfolio, the process is straightforward. The step one is just register with our investor portal using that QR link that you see in the bottom left-hand corner. Step two is then you'll review the offering documents and then complete and e-sign the process. So everything's electronically signed. So once approved, funds are wired within 3 business days. And that's just really as simple as the process is. So my role in this is to guide you throughout the process and answer any questions you have along the way. So you can see in the left-hand side, you can email me directly at Andy@Break of Day Capital, and you can set up a call with me, and I can answer any questions that you may have. But I think what Gary's discussed already and what we really like about this deal, we think it's a good time to start at a point where we think interest rates hopefully will start getting some relief, and hopefully we'll get a nice tailwind. But this, even without those factors, we think it's been underwritten well to where even if cap rates remain steady, it's still going to be a good investment in the 3 to 5 year time horizon that we underwrite these deals for. That's it for me. Gary, did you have any last closing remarks?
No, I fully agree with what you said. It's a really good time to be investing right now in real estate, in multifamily, in this deal. And if you have any questions, we are there for you. It's a no stress investing process, and many investors uh, commend us on our communication, our always transparency, and easy process. So, we'd love to have you aboard.